The rand edged higher in early trade, bolstered by dollar weakness on bets that the Federal Reserve will slow the pace of its interest rates hike. Petri Redelinghuys, trader and founder of Herenya Capital Advisors, joins us now to talk us through the latest market moves. A happy Monday to you. It would seem that this is a good start to the new month. The rand is trading firmly below the 16 rand 50 mark.
Yeah, good afternoon, and happy August as well. And as you say, it's a relatively good start to the month, although historically from a sort of seasonality perspective, August is one of the weaker months in the market generally. So even though we are starting with, very optimistic outlook and a very optimistic way of starting the month, historically this is not necessarily the best month for markets. But as you mentioned, markets are kind of, generally quite forward-looking, and the expectation is that we have a number of very sharp sort of interest rate hikes for the remainder of the year, and then from next year we start sort of bringing down interest rates again, or interest rate cuts. At least this is what the market is currently expecting the Fed to do. So the market is feeling a bit more confident that we may have this inflation thing under control. However, we also do see, I suppose there was a change in the way that the White House defines a recession, which is an interesting move right before the GDP numbers were released last week. But US is technically in a recession at this stage, where they've had 2 consecutive quarters of economic contraction. So, but perhaps the market is at this stage thinking that the worst is out the way. We have now sort of entered into a recession from here. We know what to expect, higher interest rates, or interest rate hikes at least for the remainder of the year. And then from next year, we can start tapering and potentially even going back into sort of a quantitative easing type situation that we have been seeing the market, perform well under for the last decade, just over. So I don't know. We'll see. I'm a bit less optimistic than that. I think we are in for a tough year for the rest of the year. But at the moment, the market is feeling relatively confident about things. And is looking up, and this is resulting in equity markets sort of rising around the world, as well as emerging market currencies doing relatively well. We did see a bit of a mixed bag in performance at the moment. If you look at the US, it's kind of flattish to slightly negative from where they ended on Friday, but our market at least off to a good start, about 0.5% higher on the local market so far. The rand just about 0.75% stronger, so a relatively decent start to the week.
Hey, we'll take that goodness, even if it's for half a day. On the commodities front, oil prices have dropped on the back of Chinese data signaling lower demand, while gold holds steady.
Yeah, so as mentioned, obviously a sort of global economic slowdown. It is obviously most evident in the US, but as we know, if the US catches a cold or sneezes, the rest of the world catches a cold. So this sort of economic slowdown is definitely something that is playing out throughout the course of the world. It's interesting now. So gold, the oil price is slightly down by around 0.2%, trading currently at about $103 a barrel. I think the interesting thing here to do, or later this month, we'll be hearing again from OPEC or OPEC Plus, which will, I guess, make a call on oil production. So far, what we've seen, the rhetoric coming from the Middle East around oil production is that they will move to balance the market, and they feel that at the moment, the market is well supplied. So this feels to me like they want to potentially even cut oil production, which will boost oil prices, obviously, and worsen inflation. Whether or not that's going to be the case, I don't know. Something also to keep an eye out for, which I don't know if, mainstream media has really sort of started picking up on it yet. Some military equipment was moved to the Taiwan Strait by China. So this is, the month leading up to the Ukraine invasion, we saw Russia moving a huge amount of military equipment closer to the border. And now China seems to be moving, military equipment closer to the Chinese, or to the Taiwan Strait. There were some comments over the weekend from one of the, a Chinese general saying that China will defend the integrity of, Taiwan vigorously, and anybody who stands in the way will bear the consequences. So perhaps in the next month or so, we might see China make a move to take Taiwan. If that happens, I do foresee markets catching a bit of a speed wobble. But for now, as the market is feeling confident that the recession will be over by sort of next year, it is sort of trading relatively strong. Well, energy prices on the down, just as during the short term there is a bit of a supply or a demand reduction. But I think that a lot of these things are temporary, and we probably see an oil price that remains sort of in the plus $100 to $120 range for some time.
Just on the China-Taiwan dynamic, sure. How possible is that? I mean, does China not have a lot to lose? It's well positioned right now as, one of the world powers.
I think that China is probably likely to make a move to become, they want to ascend to be a superpower, right? They've been playing second fiddle for a long time. And I think that now is a good time for them to do that. I think, they've seen sort of with the Russia-Ukraine conflict that there aren't really such harsh consequences. Okay, you get sanctioned. Yay. It doesn't really make too much of a difference to them, right? They've already kind of positioned themselves very close to Russia. Nobody wants to buy Russian oil. They'll buy it for cheaper, right? It works out for them. So I think that they might make a play to take Taiwan. Hey? I really do. And I think that there's not really much anyone's going to do to stop them, to be honest with you. And I think that they know that.
Sure. We'll look out for that development. A quick question on Liberty 2 Degrees and company news. They've released their financials. Talk us quickly through their performance.
Yeah, so actually quite encouraging. Look, I mean, there are still some headwinds, if you will, where the sort of what they call portfolio rental reversions. So this is basically, catching up some missed payments and, increasing rental for people who have historic agreements with them. That's still under pressure, so that's still sort of minus 16.3% year to date. But last year, or the same period last year, first half of 21, was minus 25%. So that is quite a good increase or recovery in that sort of number. And then the in-force escalations. So basically, this is you have a rental agreement, you have an annual increase. That's sort of at a healthy 6.8%, they say. So that is, I guess, encouraging. But the rest of the stuff looks good. Hey? I mean, the dividend has increased by 10% or just over 10% to 17.48 cents per share. Portfolio sort of foot count, so just, number of people moving through the malls and through the stores is up by 25%. Retail turnover is up by 25%. Foot count is up by 28%. Turnover is up by 25%. Rental occupancy is up to 97.2%. So this is the signs of a recovering economy, right? It's fantastic news. Also, what's interesting is hotel occupancies is up. So Sandton City or Sandton Sun, they mentioned at 71.5% occupancy compared to the previous period of 39%. And Garden Court up to 40% compared to the previous period of 12%. So still, I mean, not really, that great, but it shows tourism is recovering as well. So good news for the hotel sector. I think that we're probably going to see some surprisingly positive results coming out of some of the hotel groups later this year.
Petri Redelinghuys.
So yeah, it does show a bit of a recovery in our economy, which is fantastic.
Always good news that. Petri Redelinghuys, founder and trader at Herenya Capital. Thank you very much.